Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. We're going to discuss some of the key themes driving markets. These include the recent equity market volatility, the spectre of inflation and the outlook for global markets. Mark, let's start with the recent equity market volatility. What exactly did cause that, and do you expect a rougher ride in markets this year?
Well, as we know, equity markets over the last few years, but the last couple of years particularly, have performed pretty well and had enjoyed a very strong run. Valuations beginning to look a bit stretched, and investors had a lot of profits to take. So I think that was the first factor. Second factor is markets have been driven by many things, but one of the things they've been driven by is low bond yields. And bond yields have been low because of monetary stimulus, but also because of low core inflation. And we've seen the US Federal Reserve start to raise interest rates modestly, but they are raising them. But we've also seen a couple of warning signs about inflation, which raised the prospect of interest rates being raised more aggressively, raising bond yields, and then sort of undermining that valuation support that equities had enjoyed. So high valuations plus a slight uptick in inflation fears caused the sell-off and the uptick in volatility. With regards to a rougher ride in markets, there's no doubt that markets have enjoyed a strong run for a long time. From the bottom of the financial crisis, global economies are growing very nicely, expanding in most places, and that's supporting corporate profits. But given the amount of profit that investors have got on the table, given how far valuations have moved, I think there is the likelihood that we will see more volatile markets going forward.
And volatility has been low for a long time. It's a key feature of markets usually, isn't it? Yes,
absolutely. As I said, the fundamentals are pretty supportive. I don't see any realistic prospect of a slowdown, let alone a recession. The global economy is expanding very nicely, but we have to remember where we've come from, and we have to bear in mind where valuations have got to, not just in equities, but also in credit spreads and corporate bonds more broadly.
And are you concerned that we may see inflation coming through higher than expected, and then central banks tightening more aggressively as a result?
I think the risks have risen. Unemployment continues to fall globally. But in the US, where it's approaching 4%, it has reached levels which would have traditionally indicated full employment. So that's first thing. Secondly, and somewhat unusually, after 9 years of an economic expansion, the current political regime in North America have decided to loosen the fiscal reins and give the economy a boost, which, as I said, at this stage of the cycle is unusual and has the potential to be inflationary. That said, deflationary forces are still widespread, whether it's through technology, whether it's through demographics. But I think the risks of inflation have risen modestly, and I think that's one of the reasons why markets have become unsettled.
Now, credit markets seem disinterested in the recent market correction. What are your thoughts on credit, given how late cycle we are?
Clearly, if the economy is in good shape and corporate profits are growing, then companies are very well placed to continue to support and pay down their debt. And I think that's a pretty supportive backdrop for corporate credit. We've seen a slight uptick in M&A, and companies are beginning to do slightly un-bond friendly things, but it's marginal. I think valuations are now looking pretty full, and we are quite late cycle. So we've been taking money off the table, both in terms of high yield bonds and investment grade credit.
And what's your outlook for the UK economy, given that we've got this backdrop of ongoing political uncertainty and, of course, the Brexit negotiations?
Well, in isolation, I think the Brexit negotiations continue to be a dampener on the outlook for growth in the UK. And we don't know what sort of arrangement we're going to have with our largest trading partner going forward. And that has to be a bad thing. In addition, the Bank of England has started to raise interest rates. Again, that's unhelpful. But saying that, a growing global economy, which we've just been referring to, is supportive for the UK. And our largest trading partner in terms of Europe is also enjoying strong growth.
In the US, we have a tailwind for 2018 coming in the form of President Trump's tax reforms. How bullish are you on the US now?
Growth, I think, will be robust in North America. We're seeing the tax reforms starting to change corporate behaviour. That's certainly a positive for corporate earnings. It's less positive for the consumer because the tax reforms are largely benefiting the wealthiest in society, who generally don't spend their additional gains. But certainly the companies are likely to deploy their capital in a different way.
In Europe, we're also seeing robust growth, and capex is also up. What's your outlook for the region?
We've got very supportive monetary policy. There's clearly the bond buying programme is ongoing, albeit likely to come to an end. The global economy is growing, and Europe contains many of the world's best and largest exporters, and that's obviously been a positive. Unemployment is falling. There's a long way for that to go in many countries, but Europe looks pretty well set.
Mark, thanks very much.